Have you ever wondered how the new Trump administration could directly impact your investments and financial security? With the global economy at a point of uncertainty, volatile interest rates, and possible changes in fiscal policy, many investors are asking, where will my money be safe? If you have invested wealth and seek protection against crises, you need to understand which assets offer the most security in this new scenario. In this video, I will show you why gold, bonds, and real estate funds can be the best defense for your money, how these strategies work, and what you can do today to shield your capital. If you want to avoid mistakes and make informed decisions to protect your financial future, leave your like, subscribe to the channel, and stay until the end, because this video could save your wealth. When Trump returned to office, I knew the economic landscape would be filled with volatility, but also with opportunities. As an experienced investor, my focus has always been on protecting my wealth while seeking strategic growth. The first thing I did was analyze the impact of his economic policies on key sectors, remembering what happened between 2016 and 2020. Tax cuts, deregulation, and strong stimulus for the domestic market. Knowing that an increase in the fiscal deficit could put pressure on inflation and force the Federal Reserve to raise interest rates, I made some strategic decisions. First, I increased my exposure to gold. This asset is always appreciated in times of uncertainty, and with the possibility of higher inflation, it was an essential safeguard. I bought both physical gold and ETFs backed by the metal, ensuring liquidity and security. At the same time, I reduced my exposure to stocks of companies that could be negatively impacted by a more aggressive trade policy against China. Some major technology and automobile companies, such as Apple and Tesla, had supply chains dependent on the Asian country, which represented a risk. Instead, I directed part of my investments into sectoral ETFs focused on defense, energy, and banks, sectors that could benefit from new policies. I also took a strong position in inflation-indexed government bonds, TIPS in the U.S. Since the market expected the government to increase spending without a robust fiscal counterbalance, I knew inflation could rise. These bonds provided me with returns adjusted for price increases, protecting my purchasing power without excessive risk. Additionally, I took advantage of the impact of interest rates on the real estate sector, with the possibility of more accessible credit due to political pressure on the Fed to keep rates low. I saw that real estate funds focused on corporate offices and logistics would have great potential. Companies would need to expand operations and inventories, and well-located commercial properties could guarantee good returns. So, I bought shares in strategic REITs, ensuring a growing stream of passive income. Finally, I diversified my exposure to the U.S. dollar. I knew that if Trump hardened his policy against China, the dollar could appreciate, making international investments more expensive. So, I hedged with dollar-denominated assets, ensuring that my portfolio was protected regardless of market direction. Today, looking back, I see that these decisions were crucial. My diversification strategy between gold, index bonds, real estate funds, and strategic sectors allowed me to grow my wealth without fear of losses. And you, how would you invest in this scenario? Trump's return to power would bring a series of significant economic changes. Historically, his policies have focused on tax cuts, domestic market stimulus, and deregulation of strategic sectors. But this also means increased public debt, inflation, and market volatility. If we look back at 2016 to 2020, we saw massive tax cuts boosting the stock market, but also generating enormous fiscal deficits. Now, investors are wondering, will this strategy be repeated? When it comes to personal finance and investments, the first rule of wealth preservation is to anticipate risks and act before it's too late. In today's scenario, there are concerning factors: high interest rates, unstable inflation, and potential changes in monetary policies. A single strategic mistake can mean irreversible losses, especially for those building a long-term portfolio. So, if you want to learn which assets can guarantee your security, like this video and comment below. What is your biggest concern with the new government? Economic uncertainty is not just an abstract concept. It directly affects every investor's pocket. For example, if the government decides to increase public spending without an efficient fiscal counterpart, it could accelerate inflation and devalue the dollar. The result? Reduced purchasing power and unstable investments. Those who don't anticipate these moves end up paying the price. We saw this happen in the 2008 crisis, the 2020 pandemic, and even in recent market fluctuations. That's why the question you need to ask yourself is, if the worst-case scenario happens, is your money safe? The good news is that there are historically solid assets that can serve as a financial shield. The first is gold, which is always appreciated during crises. When political or economic instability arises, investors flock to gold as a reliable store of value. Moreover, it does not depend on banks or governments, making it an asset that preserves purchasing power over the long term. And if you already invest in gold or thinking about it, comment here. What is your favorite strategy for using this asset in your portfolio? Another essential asset is government bonds. While the stock market can be unpredictable, government bonds offer stable and predictable returns, making them one of the safest instruments for conservative investors. During periods of high inflation, inflation index bonds ensure that your money does not lose value over time. Meanwhile, fixed-rate bonds can lock in a good return during periods of falling interest rates. And if you haven't yet invested in bonds, this could be an excellent opportunity to diversify without taking major risks. Now, if you're looking for a way to protect your capital while generating passive income, real estate funds are a great alternative. The real estate sector has shown resilience over time, and funds investing in commercial properties, logistics warehouses, and even shopping centers can offer solid returns even during crises. The key is to choose well-managed funds with long-term contracts, ensuring a predictable cash flow. But beware, not all REITs are safe, and understanding the details before investing can help avoid major losses. Now that you know the 3 pillars of wealth protection, let's talk about how to apply them in practice. First, review your portfolio and identify high-risk assets that can be reduced. Then, distribute your capital between gold, government bonds, and real estate funds, adjusting the weight of each asset according to your investor profile. Smart diversification is the key to a resilient portfolio. And if you want to learn more about how to build a crisis-resistant portfolio, subscribe to the channel now, because we always bring content that will help you invest safely. Another crucial point is avoiding common mistakes that many investors make in times of uncertainty. One of the biggest mistakes is making decisions based on panic, selling solid assets out of fear of volatility. Another mistake is putting all your bets on a single asset, believing there is a magical solution for wealth protection. The truth is that no single strategy works alone. It's a combination of safe assets that builds a truly protected portfolio. Federal Reserve decisions are influenced by the government's economic policies. If Trump adopts expansionist measures, such as tax cuts and fiscal stimulus, this could push inflation up, leading the Fed to raise interest rates to control rising prices. How does this affect conservative investors? Higher interest rates make Treasury bonds more attractive, while riskier assets, such as stocks, may suffer declines. This means that investors need to balance their portfolios, considering options like TIPS, Treasury inflation-protected securities, and gold. During his first term, Trump significantly increased U.S. public debt. If this trend continues, markets may price in a higher risk for government bonds, increasing their yields. This could be advantageous for fixed-income investors, but creates uncertainties for the broader economy. How can investors protect themselves? By opting for inflation-linked fixed-income funds or diversifying into non-correlated assets, such as commodities and real estate. Sectors like energy, technology, and defense could benefit from pro-business policies and deregulation. Companies like Lockheed Martin Defense, ExxonMobil Energy, and major banks could see their stock prices rise. On the other hand, sectors like renewable energy may suffer from subsidy cuts. How can investors take advantage of these movements? By maintaining a strategic vision and investing in sectoral ETFs, which allow exposure to these segments without concentrated risk. If Trump tightens trade policy against countries like China, the dollar may appreciate. This directly impacts investors with international assets, making foreign investments more expensive. However, a strong dollar also pressures exporting companies, which may lose competitiveness. Recommended strategy: balance the portfolio between dollarized and domestic assets to minimize exchange rate risks. Bitcoin and other cryptocurrencies have gained strength as a store of value during crises. If the new government adopts expansionary economic policies that generate inflation, decentralized assets may attract investors concerned about the loss of purchasing power. But there are risks. U.S. regulators may tighten cryptocurrency regulations. How to invest safely. Gradual exposure through Bitcoin ETFs or dollar-backed stablecoins. The U.S.-China relationship has been one of the main factors of market volatility in recent years. If Trump resumes aggressive tariffs on imports, sectors like technology and automotive may be directly affected. How does this impact investors? Companies like Apple and Tesla, which depend on China, may see their margins shrink. The best approach is to evaluate emerging market ETFs and international funds that can balance potential losses in the U.S. Higher interest rates make financing more expensive and can cool the real estate sector. Additionally, incentives for infrastructure projects can raise property prices in certain regions. For investors seeking protection, corporate office REITs can be a good alternative, as they tend to benefit from business demand. On the other hand, residential properties may experience greater volatility. Trump has a history of deregulating the financial sector, which can benefit banks and fintechs. This will make credit more accessible, but also increase systemic risks. For investors, bank stocks like JP Morgan and Goldman Sachs may present opportunities. However, it is important to assess the long-term impact of deregulations, especially in sectors that depend on government protection. The government's approach to taxes and fiscal incentives can create a more favorable environment for entrepreneurs. If new tax cuts are implemented, sectors like technology and e-commerce may grow rapidly. Small investors can take advantage of this by investing in startups or mid-sized companies that may benefit from the scenario. Given the uncertain landscape, hedge strategies become essential. Alternatives like gold, hedge funds, and dollarized assets can protect wealth. Additionally, the use of derivatives, such as put options, can minimize stock market losses. Conservative investors should also consider international allocation strategies to reduce risks concentrated in the U.S. economy. If Trump follows the same strategy as in his first term, corporate and high-income individual tax cuts may become a reality again. This directly impacts investors seeking tax efficiency in their investments. For example, lower capital gains taxes make investing in stocks and dividends more attractive. On the other hand, an increase in the fiscal deficit may pressure inflation, reducing long-term purchasing power. How can investors prepare? By exploring tax optimization strategies, such as retirement funds and tax advantage accounts, as well as diversifying into tax-exempt assets like municipal bonds. During his first term, Trump suggested cuts and reforms to Social Security and Medicare, arguing the need to make these programs more sustainable. If these changes occur in a second term, retirees and those nearing retirement will need to rethink their financial strategies. How to prepare for potential benefit reductions. Investing in long-term private insurance, diversifying passive income sources, and using income investing strategies, such as REITs and consistent dividend stocks, to compensate for potential losses in Social Security benefits. Trump has already demonstrated support for the fossil fuel industry, reducing regulations and encouraging oil and gas production in the U.S. This could strengthen companies like ExxonMobil and Chevron, making them attractive options for energy investors. However, potential trade embargoes or geopolitical conflicts could generate volatility in oil prices. How to protect investments in this scenario. In addition to energy sector stocks, investors can gain exposure to commodities through ETFs and oil and gas futures, diversifying their portfolios. Furthermore, renewable energy funds can serve as a hedge against sharp fluctuations in the fossil fuel sector. If Trump pressures the Federal Reserve to keep interest rates low, credit could become more accessible, encouraging lending and consumption. This may benefit the banking sector and boost the real estate market. But there is a risk. An overly expansionary monetary policy could create credit bubbles and inflated assets, similar to what happened before the 2008 crisis. How can investors avoid pitfalls? By monitoring indicators such as a default rate and the yield curve and diversifying portfolios between defensive assets like long-term bonds and gold, while maintaining sufficient liquidity to seize opportunities in case of market corrections. The Trump administration may take a more aggressive stance on regulating artificial intelligence and big tech companies, either favoring or restricting certain sectors. With less government intervention, giants like Google, Microsoft, and Nvidia may continue growing rapidly. On the other hand, increasing trade tensions with China could disrupt semiconductor supply and affect the industry as a whole. How can investors benefit? By tracking technology funds that offer diversification, such as AI ETFs and innovation funds. Additionally, companies developing AI for military and government applications may see significant appreciation in a more protectionist environment. If you made it this far, congratulations. This shows that you truly care about the future of your wealth and want to make smart decisions. But I want to know, which of these strategies do you already use? Or do you have any questions about how to apply them to your specific case? Leave a comment below, because I always read and respond to comments. Before wrapping up, let's recap the essential steps to protect your money under the new Trump administration. Understanding the economic and political impacts that may affect your investments. Avoiding excessive exposure to risk, prioritizing safer assets, intelligently diversifying between gold, government bonds, and real estate funds, staying calm and not making rash decisions during periods of volatility. If you want more videos like this, leave a like and activate the notification bell so you don't miss any updates. And remember, knowledge is the best tool to protect your wealth. See you in the next video.